The difference between economics and socioeconomics, which includes finance. Most people who study economics know about the law of supply and demand, which basically is that when the price of something goes down in the economic marketplace, generally people are more interested in owning it, and the demand, that is the number of people who want it, goes up. This certainly was true with personal computers. This is a graph of personal computer prices, the declining line, and the rising line is the number of people who own personal computers. And of course, as the price went down, more people wanted to buy them. The opposite is true when prices go up. When gasoline prices go up, for example, do people want to buy more? No, they want to buy less. So they figure out ways to conserve. They might carpool. They might buy a car with better gas mileage and so on. However, that's economics. That's the way it works in the world of grocery stores, shoe stores, and other places like that where utilitarian goods and services are traded. In the financial markets, it's completely the opposite. In financial markets, demand does not go up when price goes down. Demand goes up when price goes up. Now, this is a chart showing the price of the S&P 500 over a period of time, and on the top we have the number of people who own stocks. Unlike the personal computer chart, the number of people who own stocks goes up when prices go higher. They want more of them as prices go up, not less. All right, what about investors' holdings of stock? Again, on the top we have the S&P 500. This one is adjusted for inflation to bring out the swings a little better. And on the bottom, the percentage of ownership of stocks in the average household in the United States. As you can see, as stock prices fall, people want fewer stocks. They want less ownership of stocks. They rush to the exits. This is the opposite of what happens in the marketplace for utilitarian goods and services. When somebody holds a sale and says 50% off, what happens to volume? It goes up. More people come in, more people want to own those things. But in the financial markets, volume, that is the number of shares traded, goes up with price, not down. Instead of having more people come in the store when stocks are cheap, fewer people come into the store when stocks are cheap. There is a definite difference between economics and finance, and this affects everything that we are going to talk about today. And it's a very fundamental difference.